In this video, we're going to talk about Paysafe, trading under the ticker symbol PSFE. We're going to cover the price action over the past few days, the company itself, and the recommendations regarding buying, holding, or selling the shares. If you would like to see more stock analysis videos, please like, comment, and subscribe to my channel. But before today's video begins, I'd just like to clarify a few things about the timing when my videos are recorded, uploaded, and how much they react to the latest market updates. Those are prepared, recorded on the day before and scheduled for the next day. If there are significant and volatile movements during the trading day, they will not be reflected in the video itself. With that being said, to the extent possible, my analysis will be based on the medium term or even the long term and not necessarily on the intraday movements. The main reason why it shouldn't matter that much is because most people investing in stocks or even just trading in and out of their positions usually keep their positions open for at least a few weeks. With that being said, if there are significant movements in the stock price that happens afterwards, either they will not affect the overall picture, so in that case we will cover them the next time we're supposed to cover them, or if they are significant enough that they change the outlooks, then yes, I will do a follow-up video in the shortest delay possible with a reevaluation of what I think should happen next. Paysafe is a startup operating in online payments with branches of storage and payment products for both individual and commercial clients. It is the parent company for applications like Squirrel, eCash, and NetTeller. Its offer of value is to facilitate users to exchange money online. The appeal to the market is that Paysafe is a company that is recently introduced to the stock market and therefore attracts somewhat a lot of attention, which translates into higher trading volume and to an extent to its future stock price performance. Its stock price is fairly volatile, which provides excellent opportunities to make gains by selling at the right moment. Like many companies recently introduced into the market, Paysafe seems to have a following online amongst the retail traders who are willing to be patient with it and to even increase their investments despite a decreasing stock price. The market cap of Paysafe is currently at $4 billion, and the enterprise value is at $3.97 billion. The market cap is the price tag the financial market is willing to evaluate Paysafe stock at, with consideration to its future potentials and the short-term fundamentals. The enterprise value of the company, or EV, is the net result of the company's assets when all the debts are paid off. Usually the market cap is higher than the EV, but sometimes there may be exceptions when the company may be significantly leveraged or under a lot of pressure from the selling side. The quick ratio of Paysafe is 0. The current ratio is 1.12 and the debt over equity is 0.85. So we gotta look at the quick ratio for a moment here. What this suggests is that its immediately cashable assets are none. Now, I think that this is a bit of an exaggeration, and I would focus more on the current ratio to evaluate whether the company would have solvency problems or cash flow problems going forward. For now, I don't think it does. The average trading volume of Paysafe has been 49.6 million shares, and the daily volumes have been recently 16.6 million shares, 31.5 million shares, and 21.97 million shares. The one-year beta of Paysafe is 2.32, meaning it's about more than double the volatility of the market. Its 52-week high is $19.57 and the 52-week low is $3.86. Now, let's also talk about the options market for Paysafe. In terms of volume and open interest, the options market seems to favor the calls option side. Generally speaking, the put options mean that the market expects a pullback, and the calls option mean that the market expects the prices to move up. The key strike prices where there seems to be the most interest are $4, $4.50, and $5. Honestly, Paysafe has been going through a very difficult sequence of events, and many people watching videos like mine are doing so because they hope to hear whether the stock has any chance of rebounding after such a drastic fall ever since its introduction. So far, the fundamentals haven't been very kind to Paysafe, and the price have reflected the skepticism of the market. Basically, they're not very sure if Paysafe is able to grow at the same pace as it first did. With that being said, I believe that from a purely fundamental standpoint, Paysafe does have a proven business model. It is actively trying to get involved with the cryptocurrencies and is participating in changing the financial sector to make it leaner, faster, and more affordable for businesses and individual clients alike. Essentially, the potential is there. The market has recently acknowledged the pertinence of companies like Paysafe and SoFi and PayPal because the infrastructure is getting increasingly mature to replace some of the operations currently assumed by traditional banks. Nevertheless, the short-term challenges are linked to the revenue growth. If the growth is lower than the market consensus, then the price will remain under significant selling pressure. The stock price will probably come back to where it is now at some point because this segment of the financial sector is expected to continue to mature over the next couple of years, and that would attract more investors to put their money in companies like Paysafe. With that being said, the short-term price action suggests that unless the current price is able to hold for a prolonged period of time, I would recommend to wait for it when the price seems to reach wider support before committing more capital. For the moment, I think that it would be better if no more than 20% of your allocated amount is used. And speaking of this allocation, I would recommend to keep a maximum exposure of 0.5 to 1% of your portfolio in Paysafe stock. In this current market environment, I believe that we should be careful about taking positions and risk in the financial market in general, and in the equity market in particular. Because over the past decade or so, the financial market has been living with the help of newly created capital from QEs, resulting in a massive increase of asset prices and the corresponding decrease in their yields. And the low interest rate also contributed to reinforce this phenomenon because the financial sector would see its profit margins reduced and in turn keeps the returns of other sectors and employees low as well. At the same time, the market doesn't represent the real economy, and the real economy doesn't get reflected in the price of different securities. The market is a game of supply and demand, which will depend on a number of factors, not just the fundamentals. If the asset prices only depend on the fundamentals, then their performances in the Northern Hemisphere would have been more than mediocre, because things have been mostly stagnant over the years. A few things can explain why asset prices managed to remain high despite the stagnation of the underlying businesses. The first one is that over the years, there has been more money printed by different central banks to support their own economies. But because that money is distributed to banks and expected to loan to businesses to create more jobs, and that in fact there aren't that many opportunities out there, this money became capital that travels around the world and went into the huge financial melting pot. The QEs are now wrapping up in many countries, so I don't think that it'll remain as the main driving force over the next couple of years to keep the asset prices up. But it's compensated by the arrival of new capital from different regions to North America because it's perceived as a safe haven for investors. With the rising tensions around the world, this capital inflow will probably be sustained over the next couple of years, if not intensifying. The last phenomenon is the creation of artificial bubbles that are either supported by real market trends or completely fictional ones to allow market participants to play the game of hot potato and to either create profits or to safekeep their capital. The EV sector back in 2020 is an excellent example of this. But nevertheless, what it means for the market is that the degree of uncertainty is probably going to increase over the foreseeable future, as the expectation for a recession has been building up for more than a decade, and that the economic difficulties are accumulating around the world, especially from Asia. What this means for the market and for us is that the volatility is supposed to increase over time, which will provide opportunities to make a profit or to incur losses, depending on the timing and risk management. Another thing to note for this period of time is that we have to be very careful about having shorts. It's already riskier than having longs because the losses of shorts are not limited, right? Because there's no limit in terms of how far the stock can increase. But with the increased involvement of short sellers, I believe that the stocks been shorted will have an even higher probability of getting squeezed, which will result in potentially massive losses. So we're also observing more of an irrational behavior from market participants in the sense that very often people will choose to rush in a position not necessarily because the fundamentals are convincing, but because there's a buildup of demand in a specific stock and people will pile in to ride the gravy train with the rest of us. That kind of behavior is highly risky and may result in losses. It's worth pointing out that in 2020 and probably in 2021, the market has never presented that many opportunities, but it was also during that same period of time that many retail traders have incurred their biggest losses. A rule of thumb is that each position should be structured so that even if they don't succeed, they don't impact the portfolio stability. Positions should begin small so that there is an opportunity to average down later. And specifically for the growth stocks, I think that 5 to 10% overall should be a healthy weight for the portfolio. And each stock should represent about 1 to 3% of the positions. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.